The screen didn't flash red slowly, it slammed. One moment everything looked calm, controlled, predictable. The next moment the bids vanished like smoke, spreads widened into chasms, and silver reminded everyone why it has earned its reputation for humiliating certainty. And here's the uncomfortable part that nobody wants to acknowledge. Most people still haven't processed what just happened. This wasn't panic selling by terrified retail investors dumping positions at any price. This was positioning. Strategic, calculated, deliberate positioning. Right now, in this very moment, we're inside a narrow window where the market is quietly deciding who gets actual metal and who gets handed a paper promise that may or may not be worth anything when it matters. 36 hours sounds dramatic, I know. It sounds like clickbait, like manufactured urgency designed to trigger emotional responses. But timelines always sound dramatic right before they expire. That's not prophecy, that's pattern recognition. Silver doesn't announce regime changes with carefully worded press releases or regulatory filings. It does it with sudden absences, absent offers where there used to be willing sellers, absent liquidity where depth charts used to show comfortable cushions, absent patience from those who actually need the metal for manufacturing, for production, for real-world applications that can't be postponed or negotiated away. Under $80 isn't a bargain because it's cheap relative to some arbitrary historical level. It's a bargain because it may not exist much longer in size. That distinction matters far more than price itself, and almost nobody talks about it openly because it sounds too alarmist, too much like fear-mongering. But it's not fear-mongering when it's backed by observable market behavior. Let's slow this down just enough to see what's really happening beneath the surface noise, beneath the charts and the commentary and the endless debates about technical levels. The silver market isn't large. It's thin. That's not an opinion shaped by bias or agenda. That's mathematics. Compared to equity markets, bond markets, even gold markets, silver's available float is laughably small. It's a market that can be moved by flows that would barely register as a rounding error in other asset classes. When flows change direction in silver, there's no shock absorber, no deep pool of patient capital waiting to smooth out the volatility. The market doesn't glide gracefully through transitions. It snaps, it breaks, it gaps. Over the past few trading sessions, what looked like chaos to retail eyes, what appeared to be random violent price action without clear direction, was actually something far more controlled and deliberate. This was inventory being repositioned, not dumped in panic. The big clue, the signal that separates noise from information, is where the selling happened, and more importantly, where it didn't happen. Futures markets absorbed pressure. Paper contracts absorbed pressure. The visible exchanges showed weakness. But physical premiums, the actual cost of taking delivery of real metal, didn't collapse the way they normally do during a genuine liquidation event. That divergence between paper weakness and physical strength is not random market noise. It's a signal. It's the market speaking in a language most participants don't understand or choose to ignore. When futures weaken significantly but physical demand refuses to blink, refuses to follow paper prices lower, it tells you something specific. It tells you someone with substantial capital and clear intent is intentionally allowing price to soften in visible markets while quietly securing supply elsewhere in less visible channels. That's not fear-driving behavior. That's planning. That's strategy. That's smart money operating while retail money panics or celebrates, depending on which side of the trade they happen to be on. Now here's a piece of information that doesn't circulate widely on social media threads because it doesn't fit neatly into a bullish or bearish meme that can be packaged into a viral post. Industrial demand for silver is not flexible in the short term. It's not negotiable. It's not optional. You can delay a stock purchase. You can postpone a bond allocation. You can wait for better entry points in speculative trades. You cannot pause a manufacturing line that requires silver as a critical input without causing downstream operational losses that dwarf the cost of the metal itself by orders of magnitude. Solar panel manufacturing, electronics production, medical equipment assembly, defense system components. These sectors don't trade silver as a financial instrument. They consume it as a necessary material input. And when consumption demand collides head-on with financial stress in the paper market, with liquidity crunches and margin calls and forced liquidations, something always gives. One side has to bend. Historically, across decades of market cycles, it's never the industrial users who blink first. They can't afford to. They pay up quietly, without fanfare, without press releases, because the alternative is operational failure. Production shutdowns, contract breaches, revenue loss. That's why price suppression phases in silver tend to end abruptly rather than gradually. The market doesn't debate philosophical questions about value forever. Eventually, it meets physical reality head-on, and physical reality doesn't negotiate. What makes this particular moment particularly dangerous for complacency, for assuming you have time to make decisions later, is the timing. We're not in the middle of a robust growth boom where excess inventories throughout the supply chain can cushion temporary shocks. We're coming off years of systematic underinvestment in mining exploration and development, rising extraction costs that make marginal projects uneconomical, and tighter financing conditions that make it harder for mining companies to raise capital for expansion. Silver isn't oil. You can't just turn a valve and flood the market with supply when prices rise. Bringing new silver mining capacity online takes years of exploration, permitting, construction, not weeks or months. Meanwhile, above-ground inventories that once acted as substantial buffers during demand spikes have been steadily drawn down over multiple years. This isn't something you notice in mainstream financial headlines because inventory stress doesn't become a trending topic until it breaks into crisis. It shows up first in small anomalies that get dismissed as one-off events, delivery delays that stretch from days to weeks, shrinking registered stocks at exchanges that most people don't monitor, rising lease rates in markets that most investors don't even know exist. By the time mainstream financial commentary finally notices and starts writing articles about supply stress, price has already moved substantially. The actionable information window is already closed. There's also a behavioral trap unfolding right now that deserves careful attention because it catches even experienced participants. After violent price moves in either direction, markets often enter what professionals call a hesitation phase or consolidation period. Everyone feels burned by the volatility. Bulls hesitate to buy because what if it drops again and I look foolish? Bears hesitate to press short positions because what if it snaps back violently and I get stopped out? Volume dries up noticeably. Volatility compresses into tighter ranges. And casual observers mistake that surface calm for genuine stability, for equilibrium reached. It's not stability, it's tension. It's a coiled spring. It's pressure building beneath a surface that appears quiet. Silver is exceptionally good at using this phase to mislead market participants into false confidence. The lack of dramatic movement convinces people they have time. They tell themselves they'll watch for the next clear signal. They'll wait for confirmation. They don't have time. When the next significant move comes, and it will come, it won't come with a polite countdown clock or advance warning system. It will come with price gaps that jump over technical levels, with slippage that turns theoretical entries into actual entries at much worse prices, and with a lot of regret disguised later as hindsight wisdom about how obvious it all was. Let's address the elephant in the room with a bit of honesty and a touch of humor, because silver absolutely demands humility from anyone who thinks they have it figured out. Yes, silver can stay irrational, can trade in ways that defy fundamental logic longer than most people can stay solvent. Yes, it has systematically embarrassed confident narratives and bold predictions for decades. And yes, anyone who speaks in absolutes about silver, who claims to know exactly what it will do and when, is usually about to be taught an expensive lesson by the market. But here's the critical difference this time, and I say this carefully because those three words have destroyed more trading accounts than almost anything else. This time, the stress building in silver is no longer purely financial or psychological. It's logistical, it's physical. When markets break due to psychology, due to fear or greed or panic, they can recover relatively quickly once emotions normalize. When they break due to physical constraints, due to actual supply limitations that can't be solved by changing sentiment, they don't recover. They reset. They reprice to new levels. And those resets don't ask for permission from participants. They don't wait for consensus. They simply happen, forcing everyone to adjust. Pay careful attention to who is not selling at these levels. Long-term holders with actual physical metal in their possession are remarkably calm. You don't see panic unloading at local coin dealers or bullion shops. You don't see vault exits accelerating in the way you would absolutely expect during a true collapse scenario where everyone is trying to get out at once. Instead, what you see when you look at actual transaction data, when you talk to dealers, when you monitor premiums, is cautious accumulation on weakness. Smart money buying dips quietly. That behavioral pattern tells you something important. It tells you that sentiment visible at the surface level does not match conviction underneath among those who actually understand the market structure. Markets move not on what people say in public forums, not on opinions expressed on social media or in comment sections, but on what they do when it actually costs them something, when they have to put real capital at risk. Right now, those participants with exposure that actually matters, with positions large enough to hurt if they're wrong, are not behaving like this is the start of a prolonged downturn. They're behaving like this is an opportunity window that may close sooner than most people expect. There's also a structural reason why price under $80 feels increasingly unstable and unsustainable. At these price levels, marginal silver producers, the mines that produce silver as a byproduct or operate with higher costs, feel economic pressure. Not existential pressure that forces immediate shutdowns, but enough discomfort to make expansion plans unattractive and hedging less appealing. That decision-making process tightens future supply even as current demand remains sticky and inflexible. It's a slow-motion squeeze that doesn't look dramatic in real time. that doesn't generate urgent headlines until suddenly it becomes undeniable. Think of it like slowly compressing a spring you can't see with your eyes. Each small incremental push feels manageable, feels like no big deal. Then one day, the spring releases all that stored energy at once, and everyone acts completely surprised, even though the tension was building visibly the entire time for anyone paying attention. Now, none of this analysis means silver will rocket straight up in a perfect parabolic line without any pullbacks. That's fantasy thinking, and silver absolutely hates fantasy. It punishes it reliably. What this analysis does mean is that risk is becoming asymmetrical in a meaningful way. Downside at this point is increasingly artificial and sentiment-driven, based on fear and positioning rather than fundamentals. Meanwhile, upside is rooted in necessity, in actual physical constraints that don't care about technical charts or analyst opinions. Those are not equal opposing forces. One can be delayed through market manipulation or strategic positioning. The other cannot be delayed indefinitely. And markets eventually stop rewarding denial, no matter how fashionable or consensus that denial becomes. If you're waiting for a clean signal, a neat textbook confirmation, a comfortable entry point that feels emotionally safe and validated by other people's approval, history suggests strongly you won't get it. Silver doesn't hand out polite invitations with RSVP cards. It forces decisions under uncertainty. It rewards those who can act without perfect information. That's always been its nature. It's a stress test for conviction rather than a comfortable playground for precision trading. The people who tend to do best in this market over time are not the ones who predict exact prices to the dollar. They're the ones who understand timing windows, who recognize when opportunity corridors are narrowing, and who respect supply dynamics when everyone else is distracted by noise and drama. So here we are, sitting inside a compressed time frame with price still offering access to physical metal at levels that may not be available much longer in meaningful size. Not because silver is magical, not because charts demand it through some mystical technical pattern, but because physical reality has a way of asserting itself forcefully when paper confidence outruns physical limits for too long. 36 hours isn't about creating drama or manufacturing urgency for entertainment. It's about awareness. It's about recognizing that markets don't change when consensus finally agrees change is coming. They change when consensus is caught completely off guard, when everyone is positioned wrong. And silver has been very good historically at choosing precise moments when most people are looking the other way, focused on other markets, other assets, other narratives. This isn't a call to panic. Panic is expensive and counterproductive. This is a call to think clearly while others are hesitating, paralyzed by uncertainty. Because once this window closes, and it will close, the conversation won't be about whether buying under $80 was smart. It'll be about why nobody believed access could disappear so quickly and why premiums exploded seemingly overnight. Something subtle shifted overnight in the silver market. And if you blinked, if you were watching other markets or distracted by other financial news, you missed it entirely. Not a shift in price necessarily, not in headlines that popped up on financial news sites, but in behavior, in the quiet actions of market participants who move size. The kind of fundamental shift that doesn't announce itself with press releases or analyst upgrades until it's already irreversible, until positions are already set. When markets are truly healthy, functioning normally, they advertise liquidity proudly. They brag about depth on both bid and offer sides. They actively invite participation from all corners. What you're seeing now in silver is the precise opposite. Liquidity is being rationed carefully, not celebrated. Offers appear briefly, vanish before they can be fully absorbed, then reappear smaller than before. Bid-ask spreads widen for no obvious reason that news can explain. Delivery timelines stretch just enough to be dismissed as normal variance, until you step back and realize normal used to mean something very different just months ago. This is exactly how supply cliffs form in commodity markets. Not with dramatic explosions that make headlines, but with quiet withdrawals, with sellers slowly, methodically stepping back. And here's the part most market participants dramatically underestimate until it's too late. Once trust and availability cracks, once doubt enters the equation, price stops being the main variable people care about. Access becomes the trade. Certainty of delivery becomes more valuable than a favorable price. There's a dangerous misconception that silver shortages show up first as empty shelves at retail stores or viral photos of missing inventory at major dealers. That's not how modern commodity stress works in practice. The first fractures happen in the plumbing, in the parts of the market structure most people never see, in leasing markets where rates suddenly spike, in forward delivery commitments where counterparties start adding unusual conditions, in the willingness of major dealers to stand behind contracts without added terms or caveats or requests for patience. When you start hearing phrases in the market like cash settlement encouraged or alternative delivery options being discussed, that's not flexibility, that's not customer service, that's stress management. It's the market politely, professionally admitting It would strongly prefer not to part with physical metal right now. And the reason this behavioral shift matters enormously is because financial markets are fundamentally built on confidence, not on physical metal sitting in vaults. Once confidence erodes, once doubt spreads, the repricing process accelerates in ways mathematical models can't capture or predict. Let's talk directly about the paper to physical imbalance because it's one of those uncomfortable truths everyone in the industry knows exists, but strongly prefers not to dwell on publicly. Silver has one of the highest paper leverage ratios of any major commodity traded globally. Multiple claims, multiple contracts, multiple promises exist for every single ounce of physical metal that can actually be delivered to someone's doorstep. That system functions smoothly as long as most participants treat silver as a trade, as a speculative position, as exposure on a screen, not as a necessity they intend to take possession of. But the moment even a relatively small percentage of contract holders decide they want actual delivery rather than just price exposure, the mathematics stop working, the system breaks down. And right now, if you're monitoring delivery notices and warehouse movements, you're seeing an increase in delivery interest that doesn't align with typical speculative behavior patterns. This isn't day traders suddenly getting religious about holding bullion. This is institutional buyers and industrial consumers quietly shifting preferences, changing how they approach procurement. When that behavioral shift happens, when serious capital decides it wants metal, not promises, the market doesn't gradually adjust through smooth price discovery. It scrambles, it panics quietly behind closed doors. Another layer most casual observers completely miss is the global aspect of this pressure building. Silver isn't consumed evenly across regions and continents. Pricing signals don't move in perfect synchronized harmony across time zones. There are moments, and we're in one now, when one part of the world is effectively screaming through its actions, "We need metal now," while another region is still calmly debating technical chart patterns and support levels. Those regional divergences create arbitrage opportunities that get exploited until suddenly they can't be. When transportation costs rise significantly, when financing conditions tighten, when geopolitical uncertainty increases and adds friction to international movement of goods, arbitrage slows down dramatically. That's when regional premiums stop being minor anomalies and start becoming serious warnings about market structure. If you're only watching one price feed, only monitoring COMEX futures or one exchange, you're seeing a shadow of the real market, a reflection, not the actual market itself with all its complexity. Now let's address the narrative trap that always appears at exactly this stage in market cycles. The idea that gets repeated constantly that if it was really that tight, if supply was really stressed, price would already be much higher. That logic assumes markets are purely reactive, that they respond instantly and perfectly to supply-demand imbalances. They're not reactive, they're strategic. Large, sophisticated players don't chase price publicly, they manage it. If you're a major buyer who needs significant quantities of metal over the next quarter or two, the absolute worst thing you can do strategically is signal urgency to the market. Instead, you lean on paper markets to create selling pressure. You allow price to soften. You let weak hands, retail traders, momentum chasers exit positions. And you absorb that supply quietly through multiple channels without moving price against yourself. This is not conspiracy theory. It's basic common sense procurement strategy that any supply chain manager understands. The deep irony is that these sophisticated efforts to control cost and manage price often create the very conditions that lead to violent repricing later. Suppression works effectively until suddenly it doesn't, until physical reality overwhelms financial engineering. There's also a psychological layer unfolding right now that deserves attention because it sets up the next major move. Retail sentiment right now is completely fragmented, split into opposing camps. Some participants are convinced silver is dead money, that it will never move, that fundamentals don't matter. Others are convinced it's about to explode higher tomorrow or next week. Both extremes are usually wrong in their timing, but useful in understanding context. Markets tend to make their biggest moves when conviction is low and confusion is high. Right now, you have exhaustion on both sides of the trade. Bears are tired of pressing a market that won't collapse properly despite their best efforts. Bulls are tired of waiting for a breakout that keeps getting delayed and faded. That stalemate is not neutral ground. It's not stability. It's combustible fuel waiting for a spark. All it needs is a catalyst that forces participants to act decisively rather than just opine endlessly in comment sections. Here's where humor helps keep us honest and grounded. Silver doesn't care about your thesis. It doesn't care about your carefully constructed macro framework, your YouTube playlist of confirmation bias, or your perfectly annotated chart with trend lines and Fibonacci levels. It cares about flow, about actual buying and selling, and flows are starting to lean in one direction quietly, persistently, without applause or recognition. When flows dominate narratives, when physical movement overwhelms storytelling, narratives scramble desperately to catch up. That's when you start seeing sudden changes in tone from analysts who were dismissive or bearish just days earlier. They'll call it new information requiring updated analysis. In reality, it's old information that was always there finally becoming undeniable to everyone. Pay attention also to the behavior of substitute materials. When silver tightens, when procurement becomes difficult, you often see subtle adjustments in related markets. Changes in alloy formulations by manufacturers, shifts in long-term procurement contracts, increased interest in recycling programs that weren't economical before. These adjustments are not bullish talking points for silver bugs to get excited about. They're coping mechanisms. They're adaptations to stress. Industries don't invest time and capital in finding alternatives unless the primary input is becoming genuinely unreliable or too expensive. Those strategic decisions happen behind closed doors in procurement meetings long before they show up in public quarterly reports. By the time they're disclosed publicly, the supply issue is already well advanced and priced in. Another underestimated factor is time preference in stressed markets. The value of immediate delivery rises substantially relative to future promises. That's when spot prices start to decouple from longer-dated contracts in unusual ways that technical analysis doesn't explain. It's also when backwardation, a market structure where near-term prices exceed future prices, whispers its presence before it ever shouts. Most retail participants ignore those whispers because they're subtle and technical, because they require understanding market structure beyond simple price charts. Professionals don't ignore them. They understand that when the market starts effectively paying you to give up future metal delivery rather than present possession, something fundamental in supply-demand dynamics has shifted. That's not speculation or hopeful thinking. That's urgency expressing itself directly in pricing structure. None of this analysis guarantees a straight line move higher without volatility. Anyone promising that is selling entertainment, not serious analysis. What this does suggest clearly is that the cost of being wrong on the upside is rising faster than the cost of being wrong on the downside. That asymmetry is what serious capital pays attention to. You don't need perfect certainty to act in markets. You need favorable odds. And the odds right now are being quietly reshaped by forces that don't care about public opinion or social media sentiment. So when you hear phrases like last chance, don't automatically hear hype or manipulation. Hear context. Hear the narrowing of options. Hear the market slowly removing choices while most people are still comfortably debating preferences. Because markets rarely take things away suddenly with dramatic announcements. They take them away politely, gradually, then all at once. When this phase ends, and it will end, it won't end with a countdown or warning. It will end with price gaps, with delayed confirmations, with offers pulled, and with many people saying, I was just waiting for one more small pullback to add to my position. We're not at that endpoint yet, but we're closer than surface comfort suggests. And that's the uncomfortable truth silver has always specialized in delivering to overconfident participants. By the time the crowd realizes what changed, the change has already priced itself in completely. And that's the final irony of markets like silver. The most important regime change moments feel boring right before they become unforgettable. Right now, the conversation is still comfortably anchored to price levels, to whether under $80 feels cheap or risky, to technical support and resistance. But that framing is already behind the curve. The real shift is happening in expectations. When participants stop asking casually, how low can it go, and start quietly asking with concern, what if I can't get metal when I actually need it, the entire psychology of the market flips. That psychological flip doesn't require dramatic headlines or breaking news. It requires a few failed assumptions in the right places. And those assumptions are cracking faster than most people appreciate. One of the least discussed signals of genuine stress is how quickly sentiment can change once delivery friction becomes personal rather than abstract. It's remarkably easy to dismiss supply issues when they're just statistics and reports. It's very different when a procurement manager gets an unexpected call saying timelines have slipped or terms have changed slightly or quantities have been adjusted temporarily. Temporary is perhaps the most dangerous word in commodity markets. Temporary shortages have a well-documented habit of becoming permanent repricing events. And when those phone calls start stacking up across multiple industries simultaneously, behavior changes immediately. Nobody waits for official confirmation or consensus when production lines are at stake. They secure what they can, when they can, at prices they previously would have spent weeks arguing over. Another uncomfortable reality is that silver's role in the modern financial and industrial system has evolved quietly over recent years. It's no longer just a hedge against inflation, no longer just an industrial input for electronics. It's become a connector between energy transition goals, technology scaling ambitions, and defense readiness requirements. That puts it in a category where demand isn't just cyclical, it's strategic. Strategic demand behaves fundamentally differently. It doesn't chase dips opportunistically for profit. It builds buffers for resilience and security. And buffers, by definition, remove material from active circulation. Every ounce set aside for strategic reserves is an ounce that doesn't come back to market easily, regardless of price incentives. That's how tight markets stay tight far longer than economic models predict. There's also a timing issue that rarely gets discussed honestly. Markets tend to reprice when participants are most fatigued, not most alert. Right now, fatigue is everywhere you look. Analysts are tired of being wrong early on their calls. Traders are tired of getting chopped up by volatility. Long-term holders are tired of explaining why fundamentals haven't mattered yet. That collective exhaustion creates a strange surface calm, a sense that nothing dramatic will happen because nothing has happened decisively yet. Historically, that calm is not stability. It's the market inhaling before exhaling forcefully. Let's address the skeptics with respect, because skepticism is genuinely healthy. Yes, silver has a long, frustrating history of false starts. Yes, it has punished impatience more than almost any asset class. And yes, there are always people saying this time is different who end up sounding foolish in hindsight. But there's a meaningful difference between repeating a hopeful slogan and understanding actual context. This time isn't different because of optimism or belief. It's different because of constraints, physical constraints. And constraints don't negotiate. They don't respond to sentiment or hope. They assert themselves when ignored long enough. Another thing worth understanding deeply is how quickly narratives reverse once price actually moves. The same voices that argue today that supply fears are exaggerated will pivot effortlessly once the move is underway. They won't admit they were wrong. They'll say conditions changed or new data emerged. That's how financial storytelling works. The goalposts move after the ball crosses them, and that doesn't mean those voices are malicious. It means incentives reward reaction, not anticipation. If you wait for consensus, everyone to agree, you're volunteering to pay the premium that consensus creates. What makes this window particularly unforgiving is that it doesn't offer clarity or certainty. There's no single data point you can point to and say with confidence, this is it. Instead, there's a mosaic of small pressures, each dismissible on its own, but powerful when combined. Slightly higher premiums here, slightly longer delivery times there, slightly less willingness to sell size without conditions. Markets rarely break from one big, obvious failure. They break from many small cracks that align at the same time. And then there's the human factor that gets overlooked. When prices finally start to move significantly, the first reaction isn't excitement or validation. It's disbelief. People assume it's another head fake. They wait for the pullback that feels familiar and safe. That hesitation is what allows early repricing to happen without meaningful resistance. By the time confidence returns, by the time people accept the move is real, price has already adjusted to a new range. And the conversation shifts from should I buy to should I chase. Silver has played this exact script so many times it's almost boring. Except it never feels boring when you're living through it in real time. This analysis isn't about calling a top or bottom with precision. It's about understanding optionality. Under $80 still offers optionality. It offers choice. You can think carefully. You can decide deliberately. You can act without urgency, forcing poor decisions. Above that level, especially after a sharp move higher, optionality shrinks dramatically. Decisions become reactive. Costs increase not just financially, but emotionally. People consistently underestimate how expensive emotional decisions are in markets. They lead to poor timing, poor position sizing, and regret disguised later as strategy. A bit of humor helps here because silver has always been the market that humbles egos reliably. It doesn't reward bravado or loud predictions. It rewards preparedness. The people who tend to do best over time aren't the loudest bulls or bears on social media. They're the quiet participants who accept uncertainty, who embrace not knowing and position accordingly. They don't need to be right on precise timing. They just need to not be catastrophically wrong on structure. And structurally, the silver market is far tighter than surface-level price action suggests. So when you hear phrases like last chance, don't interpret it as a guarantee or a promise. Interpret it as a narrowing corridor. Markets don't close doors with alarm bells. They close them softly, politely, then act surprised when people knock desperately later and no one answers. If you're watching closely, paying attention to behavior, not just price, you can see the hinge moving now, slowly, quietly, almost politely. What happens next may not be immediately dramatic, or it may be sudden and violent. Silver enjoys keeping that detail to itself. But the setup, the fatigue, the tightening, the quiet repositioning is not accidental. It's what happens before markets remind participants that supply matters more than stories. And when that reminder arrives, when physical reality reasserts itself, it doesn't negotiate with comfort or convenience. At that point, the conversation will change completely. It always does. The only question is whether you'll be watching it happen from a position of choice or from a position of forced reaction. Because silver doesn't wait patiently for certainty. It moves when uncertainty peaks.